Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Today, we're coming live here from Silicon Valley. We do this show every Friday from 12:15 to 1 Pacific time. The objective of this show is to help you improve your retirement, whether you're not in retirement yet or already in retirement. We think we can cover some subjects that can help you in either situation. And so this is a question and answer show. You can send in your questions to Ask Tom at talkmoneywithtom.com at any time, including during the show, or you can do the chat, put in your questions there. Ethan is joining us today. He's going to be our moderator. So he'll gather those questions and ask them, and I'll answer, and he'll, answer his parts and what have you. So you can even ask a question directly to Ethan if you'd like. So that's what we're doing here, and we really believe strongly that one of the best ways to improve the success of your retirement is to understand more about retirement planning, tax planning, and investment management specifically. So what we would like you to do, if you're interested, if you want to continue to kind of increase your knowledge, this particular channel, this Talk Money with Tom channel, is really important to us. We've been putting a lot of content out here. We have hundreds and hundreds of different videos on different subjects. So if you'd like to get notified when we put something new on there, you can hit the subscribe button, hit the little bell, and you'll get notified. Or you can actually send us your email address to the Ask Tom email address you see there, just to get your name on our email list. And if you'd rather just have an appointment and meet with us and ask something kind of personal as far as that goes, you can go to our website. There's a link there on this page also. And up in the corner, there's a book appointment button. Push that, you get access to our calendar, and you can pick a half-hour time that works for you for a video or a phone call, and we can at least see what we can do to help you. So that's our process here. Very excited. I want to thank you so much for joining us. We've really, really enjoyed doing the show so far. So look forward to talking to you about all these things. I'd like to start off the week with a commentary about kind of a summary of what I saw happen in the market this week. Really straightforwardly, this week was all about inflation. The market was doing, fine Monday, Tuesday. They reported, inflation numbers that were quite high at 6.2%. On Wednesday, market dropped pretty strongly. It did come back Thursday and Friday. It's up at the moment as we speak, a little over 0.5%, which is great. Still looks like we might have our first down week in a while this week, at least for the S&P 500. And so let's talk about inflation and kind of, how that impacts stocks, and then really what I think might happen coming forward here. Just flat out from the very beginning, I'll say that I think that in this particular environment, even though we have higher inflation, I still think you can make money in the stock market, especially in the right types of stocks. Normally, the big fear about inflation is that earnings will drop because a company would have an increase in costs, and then they can't pass that increase along to their customers because competitive pressures or what have you, and you end up with a situation where earnings start to drop, and ultimately earnings drive the stock market, and if earnings are dropping, the stock market's probably going to come down also. The other expectation is that the more inflation moves upward, the more that we'll see the Federal Reserve get more aggressive in raising rates. And when you raise rates, that raises borrowing costs, which create less liquidity for the stock market as far as that go, and less liquidity for consumers and et cetera. So let's address some of those. First of all, if you look really closely, the number that they're talking about, this 6.2%, was from last October to this October. And if you look at what was working in that same time frame in terms of investing, you'll find a lot of companies that can really do a very good job of managing their business and sometimes be able to push along the increased cost to their customers. I'll give you a great example just to solidify this point. Look at Microsoft. So Microsoft was actually up 65% from last October to this October. So inflation's up 6.2. One of the keys to making sure that your retirement can keep up with inflation is to have some stock market pieces. There's two pieces historically that have done well: stocks and real estate. So let's talk about Microsoft. And so one of the reasons they can do well in an inflationary environment is just because of the fact that they have, great name recognition. People know who they are. They have a great market share, right? And they have an installed base that's very, very strong. So, for example, here at our practice, we have Microsoft everything, the operating system, Microsoft, Office 365. We use the, Microsoft Teams, et cetera. So even if the cost goes up, it would be painful for the practice to pay that, but we're not going to stop it just because there's really no place else to go. So that's another key thing is low competition, and or offering some unique products that you have or what have you. So there's kind of a category of stocks that are able to continue to increase their prices as their costs rise, and they'll do quite well. So that's why you want to look at companies like that have that name recognition and market penetration. And if you actually look at the S&P 500, it is full of companies just like Microsoft, which is now the number one stock in the S&P 500, but all kinds of companies with great name recognition, low competition, and what have you. And you've got a scenario where you can hopefully keep up with inflation. That index was up 42.7% from last October to this October. Again, when inflation is 6.2%, that helps a lot in that direction. So my overall outlook right now is that the demand is surging upward and people are continuing to buy and continuing to want more. And I think that's just going to get more and more so, especially as we head into next year. I'm hearing more and more from my clients, for example, on how much they want to get out and do things or how many trips they have planned for next year, and those types of things. So as that demand moves up and really, really increases, even if things cost more, they continue to buy. And so that means that the earnings can at least maintain. And the growth on earnings in that last 12-month period has been fantastic. So even though we had high inflation, earnings still grow very well because the demand was so high, they're willing to pay the higher price. And so the consumer, both the business and the personal consumer, is in very good place right now. Lots of cash on hand as a whole, and lots of pent-up demand. So I think it will probably continue to see an inflationary environment for a while here, but I don't know that it's going to dramatically impact the earnings of some of these great companies. So that's one piece. And then the other piece is just what the Federal Reserve is going to do. Ultimately, long term, the Federal Reserve has the big, at least in my opinion, impact on the big downturn. So, 2008, we had 21 upturns in the Federal Reserve's Fed funds rate before the market really came down. We had like 19 increases before the 2000 downturn. So it's very important what the Federal Reserve does. And as inflation gets stronger, there's some expectations that they might be doing this a little bit sooner. But keep in mind that rates are basically at zero right now. And if you look at even 2019, rates were about 2.5 to 2.25, someplace in that range. For example, Microsoft made 55% in 2019. It was a good year, but it just shows you that companies can still make money even if the borrowing costs go up. It's just ultimately when you really, really ratchet that borrowing cost up, that's the issue. But that's probably a pretty long ways away from here, and there's a lot of potential gains in between here and when we get too high on the interest rates with the Fed funds rate. So very fascinating. Obviously, as a consumer, inflation is a bad thing. It's tough going to the grocery store and those types of things. But right now, there are an awful lot of companies that are doing very well in this environment. I don't see that changing. I think when the market sells off on Wednesday, I think they're thinking about the old version of inflation like we saw in the 70s. This is a reopening of the economy with a surging demand that's going to continue to pay these higher prices. And as a whole, both businesses and consumers seem to be quite capable of paying this at this point in time. So really interesting to see what's going to happen here and go forward. But I would basically keep that positive mindset. That's what's been winning here altogether, because I don't see the basics changing at this point in time. I think these companies are still going to retain some pretty good earnings. So look forward to seeing what's going to happen next week. All right, Ethan, let's get started with some of the questions that come in.
Yeah, sure. So when do we start considering the high inflation not transitory, in just the new normal?
Yeah, so I think inflation's an interesting piece, right? Because it impacts us on two sides. One is a consumer, and so we really want inflation to be very, very temporary as a consumer, because going to the grocery store, going to the gas pump, right? I mean, it gets to be kind of painful. At the same time, we're also investors, at least for those of us that are watching a show like this. And so, how does that impact our investments, and what do we do? And obviously, one of the keys there is to get the investments to grow at a faster rate than inflation. That would help a lot. But whether it's transitionary or not, it's going to be kind of interesting. I actually think what we're seeing right now is going to take a while to unwind, only because the demand surge is going to be so high. One of the things that's happening that I think is a game changer is this antiviral pill from Pfizer. And so, essentially what would happen, whether you're vaccinated or not, if you've got the virus, they can give you this antiviral pill. And via the testing that they've done so far, it has kept people out of the hospital 89% of the time, right? So now we'll see what happens. That's still going through, the process to get approved, and it's got to be distributed and what have you. If it works at that level, the pandemic's over. It's a game changer. And once that confidence comes back, I'm telling you, there's a lot of people waiting, still holding back on some of their expenditures. We're going to see an explosive growth there. And it's too much growth to keep up with the supply. We have supply chain problems, we have labor chain problems, those types of things. But even if we didn't, with a with a demand surge like we're having now, and like I expect we're going to have, we're going to continue to see inflation. The Federal Reserve can do some things to try to mitigate that inflation, but getting a bunch of people to not spend money on travel or whatever it is that they're going to want to do, that's not going to happen. They already have, businesses and consumers already have the cash on hand as a group. And so they're not really having to borrow to create this surge for the next 6, 12 months, whatever that might be. What the Fed has been talking about is that would eventually drop down second half of next year. They're still only expecting a 3% year-over-year increase in inflation for 2022. I think they could be a little bit low on that, just in the sense of this demand surge could be higher than what people feel. But it's just part of the process. We've been through this before. After World War II, people came back, huge demand. People wanted homes. Obviously they're having babies with the baby boom that happened then. We had a pretty good inflationary spike in that time frame, but asset prices were doing pretty well also, and such too. So, you got to have your investments in the right place to offset this inflation. I think it's more critical than ever to make sure your portfolio is well established so that you can fight inflation, because you can't stop it per se. You can't really stop driving and not pay for the gas, or stop going to the grocery store. So those things, that's why inflation can be kind of a trap for consumers. But as an investor, you can try to offset that by finding the right thing. So I think it's going to be a bit more inflation than people thought, or especially what the Federal Reserve thought, and that is the big controversy right now. Is the Fed behind the curve? And they might be, but it's one of those things that we can't control. What you can control is your portfolio. So whether it's transitionary or more permanent, there's still ways to try to combat that as an investor, and to help yourself, either whether you're heading into retirement because now your costs are getting high, or you're already in retirement. Either one, you really want to make sure that you've got the right type of portfolio together to be able to combat inflation.
Yeah, that makes a lot of sense. So another kind of a little bit old news: on Friday, the infrastructure bill passed. Is there any kind of ETFs that look interesting because of the infrastructure bill?
Yeah, so infrastructure bill, I think it's going to actually be signed on Monday, so it's still going. But yeah, actually, there are two exchange traded funds that I find kind of interesting in the infrastructure area. One of the things to keep in mind, for example, iShares, which is owned by BlackRock, which is, they're one of the largest money managers in the world, has identified mega trends, right, that they saw. robotics and artificial engineering, clean energy, artificial intelligence, sorry, clean energy, and etc. One of the trends that they established was infrastructure, because they just looked at infrastructure as a whole, here in the U.S. and even around the world, and how much of it needs improvement, how much growth is going to happen in that area. And so they've identified infrastructure as a mega trend before the pandemic and before this bill came out. And obviously, interesting enough, this even had bipartisan support, which is fairly unusual in our current situation. And so what they've identified here in this megatrend is exactly what's happening with this bill. There is a need. There's a lot of interest. Broadband's a huge issue, right? I mean, if you've got kids that are trying to get things done that can't get into broadband because their area doesn't have as much. So, excuse me, iShares has an infrastructure ETF. The ticker symbol is IFRA. So that would be definitely something I would look at. We've had that in our portfolio in the past. And I think even if it doesn't have a huge pop right now from the bill that's coming out, because the bill's going to be spread out over 8 years, I still think it's worthwhile to look at it just because it's an overall mega trend that I think is going to continue to play out as far as that goes. Another way to play this is just through kind of transportation. And so you're going to see a tremendous amount of this infrastructure bill pushed into transportation of all types, airlines, airports, railroad transportation, etc. So what we're looking for there's another ETF called XTN, which is a transportation index that I would look at also for kind of the infrastructure play as far as that goes. That's been doing quite well just recently, probably because of the news about the infrastructure bill. But there's some individual stocks that you can play, along those lines. But it might be better to kind of own a whole basket. So those are things that I would look at in that area. But it goes beyond. Keep in mind that this goes beyond just this bill. This is something that's happening worldwide. This push to kind of increase the infrastructure. The U.S. hasn't done anything for a long time, especially in the area, say bridges. They identified 10 bridges that they think if they went down would actually have a pretty sizable impact on gross domestic product here in the U.S. And so they want to go through with this bill and redo those, or at least retrofit those bridges. And so that's a huge deal. It hasn't been done in forever. So there's some pieces that I think are long-term investment opportunities in infrastructures is still there. I think it's a viable area.
Cool. So we had a question come in chat from last week. We didn't get a chance to answer it, but if you want to chat and send us a question, this is the best way to get us our answers quick. But can you use your paid-in tax for Roth conversion?
Yeah, this came in right at the end of the show. We didn't get a chance to answer it. And can we use your paid-in tax for a Roth conversion? So we looked at this question. We're not actually sure what the question is. I think it was Aaron that sent this in. If you're watching again, you can maybe clarify it for us. I'll send in another chat. But my best guess is that what Aaron was asking was, can I use my after-tax money? So sometimes in a 401k, you'd have after-tax money. Sometimes even in an IRA, you have after-tax money. After-tax money is exactly what you want to use to pay your taxes from your conversion. You do not want to use your tax-deferred money. So, for example, if I'm going to take $100,000 out of my IRA and I'm going to move it, and I have $25,000 tax bill, just make up a number, I don't really want to take that $25,000 out of my IRA. First of all, I'll probably have to take $30,000 out because I have to pay taxes on that 25 also. But if you do the math, it just doesn't work. Now, if I have after-tax money, I could use that to pay my tax. It's a little bit tricky. If that after-tax money is in the IRA, then you kind of have to take it out in proportion. So if 20% of the IRA is after tax and 80% is, before tax, when you take out that 100,000, 20,000 would be after tax. So it's kind of proportional to what you have in there. Whereas with a 401k, you can actually get your after tax money out. There's a few steps you have to go through, kind of as a lump, and so that would work. Yes, as long as it's. I'm not sure if I'm answering the question that was asked, but if that is the question, and that's a good thing to understand. Sometimes you do have some after tax money in your plans, and yes, you can use that to pay. That would work. The whole object of a conversion from tax deferred to tax free is simply to use your taxable money to pay the tax. And that is probably the biggest hurdle to get through for most people because they don't have enough taxable money to pay the tax. And so they're, not able to really do it effectively. So anyway, that's conceptually, the answer. So if Aaron, if you're watching this, if you have some other question or you were actually thinking about something else, you can send that in and we'll get back to it.
So I can see him asking it or me a different thing. Maybe he means, say I overpaid my taxes this year. I'm expecting maybe a $5,000 refund in tax.
Yep.
Maybe I convert a little bit of my IRA to Roth using that money and then I basically don't get my refund, but then I get this Roth.
Yep.
So that could be a way you can think about it because
Yeah.
since I already paid out this tax, maybe I'm just not thinking I have it.
Yeah. I personally think a Roth is a fantastic investment. I moved all of my all of my assets into Roth, so I kind of really believe in that. But yeah, even if you have a little bit of money available, you can convert some money over. Ideally, you're doing this at a point where you're not doing it at a really high tax bracket. We've done a lot of these Roth conversion analysis, and for the most part, it seems to work if you can stay inside the 24% tax bracket. So, for a couple, that's 329,000. For a single person, I can't remember the exact dollar amounts, but you if you can convert and still keep your income inside of that 24% bracket, that seems to work for most of the times when we do these analyses. So, that's a quick, easy way of taking a look at it. So yeah, even if you could just convert $10,000 and you could afford the tax because you got a bonus at work or, whatever it is, you'd be doing yourself a huge favor long term in your retirement by having some tax-free assets, believe me.
Yeah, and usually for Roth conversion is you're a good candidate if your RMDs are going to start getting bigger than what you actually need, and
Yeah.
so
Yeah.
that's really when that kind of snowballs.
Yeah. Yeah, it's the biggest problem, we see is that some people have so much money in tax deferred assets, really a 401k with the matches and what have you. They get to 72 and they're having to pull out way more than they need. And boy, by the time they get to 80 or 85, it's ridiculous how much taxable income they're having. And it's a very inefficient retirement at that point. And it takes some planning, really starting as early as you can to kind of mitigate that problem. But that's a problem we're running into right now.
Yeah. So our next question is, you mentioned last week that investors have internal expenses in their portfolio, and sometimes they're not aware of it. Could you give an example of some of these hidden internal expenses?
Yeah, so let me just describe kind of how they work. First of all, so if we look at a company like Vanguard or iShares or State Street or what have you, and they create a mutual fund or an exchange traded fund, they have to get paid somehow, right, for creating that and all of the effort to get the portfolio in place and what have you. And so they have what's called an internal cost. And so it comes off the top. So like I believe the Kathy Wood ARC funds are about 0.75% per year is the cost. Now, for that, you're getting her expertise and she's buying and selling for you and doing these things. But what that means is that if the portfolio makes 10 3/4, you get 10, all right? Because there's 3/4 that comes off the top. And then you've got situations like with Vanguard, their specialty is very, very low internal costs. They have a very unique structure. They're a nonprofit, and then their whole process is as their funds get bigger and more efficient, they pass that cost savings along to their shareholders by lowering their fee. So, for example, the Vanguard Total Stock Market Exchange Traded Fund, which owns a vast majority of all of the stocks in the U.S. stock market in one basket, ticker symbols VTI, that internal cost is 0.03%. So theoretically, if you were to compare kind of the ARC funds to the total stock market index, she has to do about 0.7% better just, than the total stock market index just to be in the same spot. So expenses can matter, although they don't matter as much as they used to, because we used to have 1.5, 1.25, 2% expenses were fairly common. That's super hard to overcome. And that's why the S&P 500 index that was created by John Bogle has done so well and grown so much is because there was such a big disparity in managed assets that were very expensive versus an unmanaged asset, which is quite a bit cheaper. But now we're starting to see expenses, really, really reasonable in total. They don't make as much impact as they used to. It's still worth knowing about it because for me, that's a tiebreaker. If I had 5 ETFs to pick from and I felt very similar about all 5, I'm going to go with the one with the lowest expenses because it's going to have the easiest time of giving up a net rate of return, right? So it's important to understand how that works.
Um, does like an ETF ever say when they do trades or rebalance, do the costs ever get passed on, or is that already in the operating expense? And then when you buy and sell, usually there's a bid and ask price.
Right.
Is that also something you should do in your calculation? Is like, does this ETF have a big bid and ask price because it's lightly traded versus like a VTI, which is highly traded, so it's a very small
Yeah.
spread.
Yeah, no, that makes a big difference. First of all, there's the internal costs that I just talked about that are going to the company. And then there's kind of these trading costs, and that can be really variable. Those have also dropped because in general, trading costs have dropped altogether. And so one of the ways you can see that is you can take the actual S&P 500 index, for example, and compare it to the S&P 500 ETF that you have. And so you'll see the differential between those two will be the internal costs plus any costs for trading, because they've got a bid and ask cost on these individual stocks that they're buying. And then you as an ETF holder in this particular case, you would have a bid and ask cost on that exact ETF too. So if you buy it, again, what you just mentioned is exactly right. The bigger ones have so much volume that bid ask spread between buy and sell is quite low. And I think a lot of these things have become quite negligible, but that is another sort of hidden cost, is the trading costs that are inside of that potential, exchange traded fund or mutual fund that's on top of the internal costs that I was talking about earlier. Again, you can kind of see, and if you look closely, I'm not seeing massive differentials between the actual index that you can't own, it's just an index, and the packaged product that's supposed to be representing that index. They're really close, especially with the better companies like Vanguard, iShares, and State Street, for example.
That's interesting. So this is a question about with the market up so much, the S&P is up 110% since March 2020, the bottom. Do you think this would be a wise move to kind of take some risk off the table and move to a more conservative portfolio model?
Yeah, some of these questions come from our strategy sessions that we've had with our clients, and this is, and I basically we share them because we think, more people might have this question, and probably more people should hear the answer. And really, what we're asking here is like, are we in a bubble? Should we be, getting more defensive because of that bubble? We've had this great run. Should we be taking profits off the table and such? So it's a couple of pieces that are really important to understand. Number one is just this thought process of what is your overall risk in that portfolio, because at any point in time, even when the market hasn't gone up that much, it could fall, right? Pretty heavily. And so you have to be ready and able with your existing portfolio to handle the downturn. That has a lot to do with the portfolio construction, especially how much is in stock versus how much is in bond. But what type of stocks do you have? How aggressive they are? How diversified are you? So one of the things that we do, we subscribe to a firm called Riskalyze, and Riskalyze sends out an email once a quarter to all of our clients and shows them what risk they're taking in their portfolio. And for example, one of the pieces in there is how that portfolio might have done in the Great Recession loss. You know, the S&P dropped 53% in 2008, 9, and 10. And so, you know, how would your portfolio do? I think it's very important for the clients to realize, you know, what they could lose. And so that's the beginning. So, you know, whether we're in a bubble or not in a bubble, you've got to be at the right risk level so that if tomorrow the market goes down dramatically, you know, you're aware of that risk and it'll make you more comfortable to know, yeah, you lost 15 or 20%, but you kind of knew that. That was part of this, you know, structure. So now what you'd be talking about then is trying to basically do a prediction and say, okay, now we're up 110%, and I'm going to move down from 60% stock to 40 because I feel like it's already too high. I wouldn't do that actually, because one of the things that I don't believe in is kind of this predictive investing where you make a prediction and you react to that. Like inflation's going to bring down the market. Well, it might, but it might not. I'd rather wait and see and have a reactive investing portfolio. So I stay on top of it. I mean, for example, in September of this year, with the, you know, bipartisanship at situation that was happening in Congress. I was somewhat worried about what they were going to do with the debt ceiling. And obviously the market was too. We ended up with about a 5.9% drop from high to low. We were ratcheting out some of the risk and moving some of that, you know, bond pieces out. And then once they came through a resolution, we came back in. And so, because a debt default would be dramatic. So you don't want to hang around for that too badly. So, you know, there's some pieces like that that you do. If I'm going to do any type of predicting, it's just in the short term, you know, things that are going to happen in the next couple of months, maybe. So it's at 110%. It could go 400%. It could drop tomorrow. I'm going to hang in there with the right portfolio, stock and bond. I'm going to watch. I'm going to put in my protection pieces, some stop losses if I think they're needed, or be ready with a plan to how to react to these situations. Because there's no, I mean, let's face it, if we went back to last March and we were to ask people how much the market would be up by now, how many people would have said it would be up 110%? Hardly anybody. Yet it is. So could it be up another 100%? Possibly, right? I mean, is it really high right now? Yes. Can it go higher? Yes. We're coming out of a pandemic with a massive pent up demand. The Roaring Twenties followed the last pandemic. We could have another one, right? I don't know. I don't need to know. I just have to have a plan. If it goes up, I got to have a plan on how to deal with that. If it goes down, I got to have a plan to deal with that. And that's how I do it. And I think this is the best way to invest, to sort of have a reactive mentality. I run into so many clients who think, you know, that the prediction that they've read in some article is going to come true. Most predictions don't come true. And so that would be my thought process on where we're at right now. I'm super excited. We're up 110%. We've been fully invested all the way through. We made some great moves in that downturn. You know, we own Microsoft and Apple that we bought on March 5th of last year. And, you know, there's some pieces that have been unbelievable that have worked out here. And I actually, at the very moment, if I was going to make a prediction here, at least in the short term, I think the market's going to continue to march. We've got lots of momentum. And so you really don't want to miss out on these big upturns. Just be prepared for that downturn and how to deal with it. And that, you know, that's what we do.
So are you saying, so as an investor, you should be more, you know, reactionary versus predictive? And so, you know, I shouldn't be trying to speculate in a sense to predict the next great downturn, I should just be sitting where I am.
Yeah, actually, I think if you were to classify it, you should mostly be buy and hold. And so for our typical portfolio, 75% of our portfolio is just broad market, S&P 500, total stock market index, those types of things designed to just hold on to it. And the rest of our stock market exposure, the smaller part by far, is designed for some tactical movements. You know, buying some things like we just bought some clean energy ETFs, right? Because again, they're starting to move electric vehicle ETFs, those types of things. So that's a tactical move as far as that goes, just based on kind of what I'm seeing happen in the momentum. But for most part, you should be buy and hold, and then really wait for those extreme situations that you see coming to be more reactive. And sometimes, for example, in the downturn that we had last year, my first thought was trying to position the portfolio for the rebound. And so I watched very closely for things that were doing better during the downturn. That's why we bought Microsoft and Apple, for example, because it was doing better. And I felt like if something held up in that downturn, the market likes it, and maybe it'll continue to come back up quicker. That actually worked out. Doesn't always work, right? I mean, there's different situations, but I was positioning for the rebound. I wanted to recover quicker because it's very difficult to get out of the way of a market like that. That was the fastest 35% drop in history. So, you know, you're not going to get out of that. You're going to probably suffer through some of that. That's why you got to make sure your stock bond mixture is really sound before you get there. But what do you do to take advantage of it? And that's one thing that for downturns, I've gotten, you know, better at looking at that from an analytical standpoint and taking advantage of what's happening during that time frame, and getting positioned to try to recover as quick as possible. Because recovery is a big deal. I always used to use this example, you know, would you rather have a portfolio that only drops 3% but takes 3 years to get back, or one that drops 30 but only takes 3 months to get back, right? So a lot of people focus tremendously just on how much it falls. You need to also focus on how fast you can come back. So recovery, I think, is a big piece of that, especially as you're in retirement. You know, you're living off this money. You know, having it stay down for a really long period of time is tough, and you know that can happen still. There's all kinds of different markets. You know, the Great Depression was down for a long time, and so you know, trying to get defensive in the right situations, I think is good, but mainly buy and hold. Yeah, I think that's been the key. Have the right stock bond mixture and hang in there.
Cool. So in the past, we've talked about three buckets of money. You know, the taxable, tax deferred, and tax free. And it's best to have all of them. But why is it so troublesome to have majority of my retirement money in a tax deferred accounts like your IRA, 401k?
Yeah, this question and this situation also comes out of our strategy sessions with our clients. And so one of the things you see oftentimes is that, you know, people have bought a house, they've made some money on the house, right? But they don't want to sell it. So, you know, the equity in the house is just there, and for either for beneficiaries, or they could use it at some point in time. And then they had a 401k at work, right? And they put the money in, they got a match, and they don't have much money except that. So if you take a look, you know, they have a little bit of money in the bank and a ton of money in a big IRA, and you know, house equity. So it creates some problems in several different areas. Number one, when they get to be 72, they're going to be forced to take money out, and obviously it's a huge problem, very inefficient to have more taxable income on your tax return than you were using in any one year. So if you're spending, you know, 75,000 a year, and all of a sudden you're putting 100,000 on your tax return, or 150,000 or 300,000 or 500,000, because you're forced. So that's one of the things you have to be careful with a giant amount of money in tax deferred assets like a 401k or IRA. There is a forced distribution. It's called required minimum distribution, and it will drive you crazy if you have a lot of money there. So sometimes by mitigating some of that by spreading it out, I want to have some money in regular taxable accounts. So, for example, obviously you'd have checking and savings and cash and those types of things, but you can have your same type investments, Vanguard and State Street and iShares or whatever, in just a regular account. It could be a trust account or individual account or joint account or any of those types of things. And what that does is it gives you liquidity. Taxes are lower because you already paid taxes on some of the money when it went in, and they're also it's capital gains tax instead of ordinary income, which is generally lower. So that's very good, but it gives you liquidity. And that liquidity gives you all kinds of power in terms of what you can do going forward. So, for example, if somebody wants to do a Roth conversion of some of those retirement assets, now they have some taxable money to use to pay the taxes. And they can fill that third bucket. And the third bucket, I think, is maybe the most important, which is this tax-free bucket, right? So in a perfect scenario, you've got some type of distribution across taxable, tax-deferred, and tax-free. And man, if I'm heading into retirement, I am really trying to make sure I've got a distribution across all three of those areas because it just gives you flexibility. The other thing that a lot of people probably don't think about, but they can change tax laws really at any moment. And it might impact one category more than another. And so by having all three categories filled, you diversify the risk for tax law change going forward. So, if you have everything in tax free and they all of a sudden change their mind and make it taxable, well, it's a good thing that you had some tax deferred. Good thing you had some taxable. If they change capital gains rates and make it ordinary income again, well, it's a good thing you had tax free, that type of thing. So as tax laws change, you can make a really strong argument for having a distribution across those three areas. I would say this is the biggest falling down that I see for people's retirements is not having an even distribution. It doesn't have to be even, but not having a distribution across those three categories. And we do see a lot of people that have a big chunk of their money in that, tax deferred area. And that is something that would be great if you could go back in time and kind of rectify that. So it's something, even if you're retired, you can still work towards, you can still start building up those taxable assets, those types of things. So it's an interesting area, that's for sure.
Yeah, and another situation like we come across is, say I want to buy a car, but I'm retired. I want this nice car that I've always dreamed about. I have the money, but that money is in my retirement account. And
Yep.
say this car is like $120,000 car,
Right.
but it's my dream car and I want it. But then my income just jumps that $120,000 because
Right.
I have to take it from, and it's considered my income then.
Right. Yep. Yeah. So got $120,000 on your tax return. And so you're going to need to pull out even more to pay the taxes. And if you're retired, that might jump you up in brackets on Medicare. Maybe you're now paying more on Medicare, could impact, those other costs also. And all of a sudden that $120,000 car end up costing you, $175,000 after tax versus having that $120,000 in, a taxable account. Some of that money you pull out, you might already pay taxes on. The rest that is a gain, especially if it's over a 1 year gain, will be a lot lower. It could be a 15% tax on that instead of, what would have been a much higher tax as far as that goes. Have less chance of hitting your Medicare cost if you are retired, for example, those types of things. Oftentimes some people will look at, borrowing the money just to mitigate that as far as that goes. But then you run into other problems with borrowing, and now you've got a payment, and if the markets all fall apart, you've got a payment. And so it's hard to collapse, your expenditures when some of them are fixed through payments. So that's where, yeah, exactly, having some taxable assets to do that gives you that flexibility without getting killed on taxes. Yeah. Yeah. All right. So that's a wrap today. Really enjoy this. Again, subscribe, hit the bell button if you want to get content. We're putting out these videos constantly. Book an appointment if you want to, come and see us directly, phone or video. And obviously, if you can send us your email address. And I really appreciate everybody that was able to come today. I super enjoy these questions. Great scenario. Thank you for coming today, and I look forward to seeing you